To the White House, the President of the United States announcing new trade tariffs against China.
As more countries close their doors to Chinese exports and trade conflicts rise, China's once powerful manufacturing machine is starting to break down. There are fewer factories. Shipments are stuck. And the country that used to sell goods that helped hundreds of millions of people get out of poverty is now looking for a new way to run its economy. But what's going on that's not in the news? Why does China keep gold to itself? Why do Chinese businesses run away to Vietnam and Mexico, only to close down again? Also, could the world's second-largest economy really be on the verge of a financial cliff? With trade wars, falling real estate prices, and the rise of zombie factories, China's economy is going through a huge change. This video breaks it all down. If you're an investor, a policymaker, or just someone who buys things made in China, what's going on now could affect you more than you think. In the late 1970s and early 1980s, China was mostly farming and didn't have many industries. But Deng Xiaoping, who was leader at the time, made big changes to the economy that made things possible for change. These changes made it easier for people to trade and deal with other countries, and they also created what were called special economic zones. Foreign companies could do well in these zones because they had tax breaks and fewer rules to follow. Because of this, they quickly became places where cheap goods could be made. When we look at China today, it's hard to miss how big its factories are. China made about 20% of the world's manufactured goods in 2023. It made everything from toys and clothes to electronics and heavy machines. At one point, the country made 35% of all the things in the world, based on its gross production output. That's almost 3 times as much as the United States, which comes in second. Over 800 million people were able to get out of poverty because of this huge increase in production. China also jumped up the economic rankings at a speed that had never been seen before. China became the place where companies from all over the world went to cut costs, which made a lot of this possible. These companies sent their production to China, where labor costs were much lower, rules about workers' rights and the environment were not very strict, and there was a growing pool of skilled workers. China's rise wasn't just due to its business-friendly environment or internal changes. It was also helped by interest around the world. China's companies worked faster when people in the West bought more. The country turned into the world's factory floor over time. A lot of the things that people around the world use, like clothes, furniture, electronics, and computers, were made in China. Also, it's important to remember that many Chinese companies began by making simple, low-value goods, but they quickly grew. There are now a lot of very complex companies that make high-tech parts and precise tools. The country is now an important link in the supply line for electronics, cars, and renewable energy, among other things. With this much success, it's easy to see why industry became such an important part of China's economy. In fact, China's economic model has been called export-led growth for a long time. This means that selling things to other countries has been a big part of the country's GDP growth. This plan worked especially well when globalization was speeding up and countries were more willing to buy cheap goods from other countries. The current Chinese government, especially President Xi Jinping, has been very supportive of this focus on industry. Xi has made it clear that he sees industry as both good for the economy and good for the country. There has been a lot of talk in speeches and government policies about keeping China's factories running and getting young people to work in production instead of going to school or getting a white-collar job. Both words and actions have been used to make that push through. Vocational training programs, for instance, have grown, and the government continues to subsidize many areas to keep them productive and competitive. In recent years, Chinese officials have even told students that working in a factory is a patriotic task, because the manufacturing sector is so important to the country's growth and ability to compete in the global market. Of course, there is still disagreement about the quality of working circumstances. There has been growth in some places and businesses, but many factories are still criticized for having low wages, long hours, and poor safety standards. But state strategy has mostly been about output and making the economy strong, not always about labor reforms. Any changes for the better in that situation are usually caused more by pressure from other countries and close monitoring of the supply chain than by changes in internal policy. The fact that China's economic growth has spread so far is one of the most impressive things about it. It's no longer just about making a lot of cheap things. The country has put a lot of effort into areas with better value, such as aerospace, green technology, consumer electronics, and even green technology. Programs backed by the government, such as Made in China 2025, aim to make the country less dependent on foreign technology and more capable in advanced fields like robots and semiconductors. Many countries have industrial sectors, but China's is the only one of its kind in terms of size, integration, and reach. The country grows the raw materials, makes the parts, puts the whole thing together, and ships it around the world, all within its own borders or through tightly connected regional networks. China has an edge that is hard for other countries to copy because of its high level of vertical integration. This power has made people both admire and worry about it. On the one hand, countries gain from Chinese goods that are cheap and keep prices low for consumers. On the other hand, China's huge output can make other countries dependent on it, hurt local businesses, and pose risks during times of political or economic unrest. This is very clear when looking at critical areas where China has a strong position, such as semiconductors or rare earth elements. When China joined the World Trade Organization in 2001, taxes were lowered, and trade with China was boosted around the world. This made it easy for Chinese companies to sell their goods all over the world, especially in the US, which became the biggest market for Chinese goods. Since 2018, though, the swing has been the other way. The US started putting big tariffs on a lot of Chinese goods when Trump took office and every government after that. These taxes on some types of Chinese goods have gone up by as much as 145% since 2025. This big change in policy has made a real difference. Many Chinese producers, mostly small and medium-sized businesses, were suddenly unable to sell their goods in the United States because of the high prices. Their goods, which were much more expensive for US customers because of the taxes, started to pile up in warehouses, not being wanted or sold. Sometimes whole lines of products had to be stopped. Orders from American buyers stopped coming in regularly and were replaced by doubt and anger. In order to protect their businesses, a lot of Chinese manufacturers looked to Vietnam, Indonesia, Malaysia, and Mexico to build new factories. They thought that if they made their goods outside of China, they could stay in business and escape the direct effects of US tariffs. Between 2019 and 2024, there was a big rise in this activity, which is also known as tariff circumvention or origin shifting. But as more businesses went this way, the countries where the goods were going started to get more attention. For example, Vietnam saw a rise in industrial interest, but US trade officials were also paying attention because they thought that some Chinese companies were just changing the labels on goods or doing very little processing to make them look like they came from Vietnam. This caused new taxes to be threatened on Vietnamese goods sent to the US and more customs checks to be made. The same thing happened in Mexico. Factories were built fast, but it was hard to get the raw materials and technical know-how needed to make the same amount of goods as China. At the same time, some of China's most important trade partners started to think again about their own stances. China had invested in Mexico in an effort to get around taxes, and the country has thought about aligning its trade policy more closely with the US. Vietnam and other ASEAN countries have also been caught in the crosshairs. They are trying to balance their economic needs with rising pressure from the US not to become a trade loophole for China. Before this change, China had become the most important trade partner for more than 120 countries. Because of how connected the world was, any problems with China's products were felt all over, not just between China and one other country. But because of the way politics are changing, many countries are being more careful. India, Brazil, and EU members have either put their own tariffs on Chinese goods or started investigations into what they say are unfair business practices, like heavy state support and product dumping. In reality, these answers show a bigger worry. China's success in manufacturing isn't just about being efficient or low cost. It's also about using state power in a planned way to take over the world market. China's local and national government subsidies have been a problem for a long time. People who don't like them say that they let companies that aren't competitive undercut global prices. These businesses, which are sometimes called zombie companies, get help from the government to stay open, even though they lose money or can barely pay their bills. Large state-owned companies can usually handle changes because they have political and financial support. But smaller private companies don't have the same cushion. Many of them were already making very little money because there was so much competition in China. They are finding it harder and harder to stay afloat as foreign taxes and fewer chances to sell their goods make things more expensive. Some people have to decide not only whether to move or change their brand, but also whether they can stay in business at all. There have been rumors that a lot of these manufacturers are upset. In one well-known case, a company made mosquito repellent kits for stores in the US like Walmart. Their goods were stuck in storage in China after the new taxes were put in place and couldn't be shipped. A representative for the company told the press straight out what was going on and called the former president a crazy man. Another example is a Chinese company that made outdoor furniture and opened a plant in Vietnam to avoid tariffs. But the new location wasn't sustainable. The people in charge of them said that the move wasn't really worth it, because they are now going to close the plant. Another company that made Christmas ornaments for big American stores said that its US orders had disappeared. The boss said that the company was in survival mode, which is a common way to feel. Companies all over the country are trying different ways to get rid of their stock, like lowering prices on domestic social media sites and trying to attract local customers. But this isn't always working. For many of these manufacturers, the problem isn't just the tariffs, but also how unpredictable trade ties are between countries. It is much harder for a business to plan, invest, or grow if it can't count on consistent rules or easy entry to its main markets. The confusion is just as bad as the tariffs, especially for companies that are short on cash and can't easily change course. To deal with this, some companies have changed the kinds of products they make or gone after foreign markets in places like Africa, Latin America, and some parts of Europe. Even though these are good intentions, they often don't even come close to making up for the trade that is lost with the US. It's often harder to make money and move things around when sales do come in. This is a big problem because the US has been so important to China's export plan. China's yearly exports to the US have been around $400 billion in recent years, which is about 14% of the total. China has counted on exports to grow for decades, so losing this important customer is more than just a setback. It's a threat to the very way the country grows. Export-led growth has been good for China's economy for more than 40 years. That plan depended on cheap labor, government incentives, and the need for cheap, mass-produced goods around the world. China now exports more than any other country, anything from computers to socks. But as the way trade works around the world changes, and more countries speak out against what they see as unfair practices, this model is beginning to show signs of stress. At the same time, there is a big problem in China itself. The real estate market, which was a key part of the country's economic wonder, is in big trouble. For many years, building new homes was one of the main things that drove growth. It not only made jobs and investments possible, but it also turned into many middle-class Chinese families' major source of income. Things are starting to fall apart in that system now. In many Chinese towns, home prices have dropped by as much as 30% since their high point. Also, Evergrande and Country Garden, two once dominant real estate companies, have stopped paying their debts. It has had huge effects on many things, including construction, furniture, finance, and other connected industries. Real estate-related activities used to make up about 25% of China's GDP. This area is now shrinking, which means that China has lost one of its most reliable growth drivers. Local governments have also been hurt by the real estate problem. In China, land sales are a common way for local governments to make money. They rent out the right to use land to developers in exchange for big payments up front. These payments pay for services and facilities in the area. But because coders are having money problems and don't want to work on new projects, this important source of income has dried up. Because of this, local governments haven't been able to spend as much in economic stimulus or social welfare. It is very hard to try to increase local consumption because of this. The fact that China doesn't have a strong social safety net is a big reason why people save a lot of their money, more than 30% on average. Public health care coverage isn't very good. Most of the time, retirement benefits are not enough. It can be very expensive to go to school, especially for college and individual tutoring. People save money instead of spending it because of these things. This makes it harder for politicians to get people to buy more things to make up for lost export demand. China's family spending made up only 39% of GDP in 2023, which is a lot less than the average of 63% around the world. That's a big difference. To close it, the government would have to make big changes, like making it easier for people to get health care, increasing social insurance, and giving more money to families instead of state-owned businesses and local governments. But these are long-term changes to the way things are built, and they need both political will and economic freedom, which are becoming harder to find. At the same time, China's debt has been rising. After the global financial crisis of 2008, the Chinese government put together a huge stimulus plan that was worth almost 12% of its GDP at the time. That helped the economy get back on its feet, but a lot of the money went into building infrastructure and real estate, which caused too much supply and inflated the current housing bubble. Since then, there has been a big rise in both business and government debt. A lot of money has been borrowed by local governments for projects through so-called local government financing vehicles. But many of these projects don't make any money. The government is in a tough spot right now because the real estate market is in trouble, and exports are being pushed back. Real estate or infrastructure can't drive growth like they did in 2008, and the government doesn't have the money to start another big stimulus plan without making debt problems worse. Either the usual tools don't work, or they could make the situation worse. That means the leaders of China have to look for other options. One way to do this is to move the economy toward industries with better values and make the country more dependent on key technologies. This change in strategy is shown by policies like Made in China 2025 and the current focus on building new productive forces. Electric cars, solar panels, electronics, and artificial intelligence are some of these new industries. The goal is not only to come up with new ideas and add value, but also to rely less on technology and markets from other countries. But it's not quick or easy to change an economy as big as China's. It takes time to make businesses competitive, and the short-term gains might not be enough to make up for losses in other areas. Also, governments in other countries have begun to respond to this approach. For instance, the US has put taxes of up to 100% on Chinese electric cars, 50% on solar panels, and 25% on batteries. The European Union is also looking into whether China is giving these companies money, and it has already started to put its own tariffs in place. This makes it even harder for China to use new businesses to help the economy. Not only does the world not want cheap mass production from China, but it also doesn't want high tech to go too far. There is more going on than just a trade dispute going on right now. The world economy is going to change a lot over the next few decades. The government has also started to try to boost demand more directly on the inside. There have been attempts to get people to buy houses, cars, and even tools. Tech companies like Alibaba and JD.com are being asked to help by giving discounts and making it easier for people in rural places to shop online. There is also a push for domestic circulation, which is a word used in Chinese policy to describe the goal of creating an economy that can support itself by focusing on domestic demand instead of trade with other countries. These steps are only temporary fixes, though, because they don't address the real problems, such as low household income, rising unemployment in some areas, and low consumer trust. People may still be hesitant to spend when they are worried about their job chances, the value of their home, or the cost of their medical bills. And when the economy slows down, companies don't hire as many people or raise pay as much. This keeps consumption low. The Chinese government doesn't have many easy choices now because of all of this. It's not enough to just tell people to spend money to boost domestic demand. People also need to trust the future, which can't be done with slogans and handouts alone. It needs systemic change and a rebalancing of the economy so that families have more power and resources. China is at a very important turning point because foreign markets are getting tighter and weaknesses at home are getting worse. Its main sources of growth, like export-oriented mass production and a strong real estate market, are under a lot of pressure from all sides. Instead of freaking out, the Chinese government has been working on a number of fronts to keep things stable while getting ready for what could be a long-term change in the country's economic place in the world. China's increased attention on gold is one of the most interesting things to happen in the past few months. In a world where currencies change all the time and trade wars can ruin years of planning, gold is still one of the few things that everyone agrees is important and doesn't have anything to do with politics. The Central Bank of China, the People's Bank of China (PBOC), has been slowly adding to the country's gold reserves. China now has more than 2,200 metric tons of gold, according to numbers that are known to the public. This number has been going up every month since late 2023. There's more to this than just wanting to be safe with money, though. By getting more gold, China is doing something very smart. It is relying less on the US dollar, which has been the main currency for foreign trade and finance for many years. Moving reserves away from dollar-denominated assets like US Treasury bills and putting more weight on gold and other currencies is a process that is sometimes called de-dollarization. For Beijing, this is a way to protect its economy from more penalties, unstable finances, and political pressure from Washington. This move also tells us something. If the world's financial systems get more split up, which looks like it will happen, China wants to make sure it can work outside of structures run by the West. Gold is not tied to the rules or choices of any one country like currencies or financial instruments are. It's kept safe, respected around the world, and doesn't depend on computer systems that can be shut down or frozen. This plan to buy gold sped up after the West put sanctions on Russia for invading Ukraine. This is not an accident. China paid close attention and learned the lesson. Spread before you have to. There has been a big effect on the world gold market. Gold prices have reached all-time highs because of high demand. Central banks, such as China's, are leading the way. Early in 2025, the price of an ounce of gold went above $3,500. This was caused by a mix of factors, including political unrest, rising prices, and more sales by governments across the country. But for places like China, the goal isn't always to make money quickly. It's about safety in the long run. Gold is just one piece of the bigger picture, though. At home, the Chinese government has also been stepping up its efforts to help exporters who are having a hard time by helping them refocus on new markets. China has been looking to Africa, the Middle East, Latin America, and Southeast Asia as different places to sell its goods, since it is getting harder to get into the US market because of tariffs and political unrest. There are more trade trips, diplomatic visits, and deals for regional investments. China has also been improving its trade relationships through programs like the Belt and Road Initiative. It hopes that partner countries' investments in infrastructure will increase demand for Chinese goods in the long run. But it's not easy to change exports on this level. It's possible that many of these alternative markets are smaller, have less buying power, or already do business with local providers. Also, people around the world have started to change how they feel about Chinese items in recent years. Some countries are being careful because they are worried about quality control, cybersecurity, and the dependability of the supply chain. No longer are tariffs and limits on imports just something that the US does. Some Chinese goods are now subject to anti-dumping charges in India, tariffs have gone up in Brazil, and the European Union is looking into whether subsidies may hurt competition. China has also taken steps to boost internal consumption even more in response to these problems. The plan is to try to get Chinese people to buy more instead of exporting as much. At first glance, this seems simple, but it's much harder to do in real life. In China, the economy has always favored investment and production over spending by individuals. To turn the country's economy inward, you need more than just rewards. The structure of the country needs to change as well, and that means changing China's social safety net. People don't spend freely when they're worried about their health, their retirement, or the schooling of their children. Economists say that people will continue to save a lot unless the government does something to improve retirement, public health insurance, and help for people who are out of work. That's exactly what we see. Even though the government has programs to get people to spend money, Chinese household consumption as a share of GDP is still low, nearly 20 percentage points below the world average. Even so, there are signs of change. Big Chinese tech sites like Alibaba and Douyin are now giving foreign companies tools and rewards to help them get into the Chinese e-commerce market. These sites help manufacturers reach customers in their own country who might not have found them otherwise by helping with everything from marketing to logistics. Even though this can be useful sometimes, it's only a temporary fix. The real test is whether China can change its economy so that it is not based on foreign demand or investments from the government, but on growth from Chinese consumers. The government in each area has also been trying to help. A lot of people are giving small and medium-sized producers loans with low interest rates to help them get through the current economic downturn. Others are setting up trade shows or online sites where companies can show off their goods to new customers. These steps show that the issue is being taken seriously by the government. That being said, the task is huge. It's not enough to help a few businesses that are having trouble. We need to rethink how the whole economy works. At the same time, China is becoming more worried about the high rate of unemployment among young people, which is the highest it has ever been. It's another point of pressure because it has an effect on both social security and the power of consumers in the future. When young people don't have jobs, they don't just lose money. They also put off starting families, buying homes, and getting big-ticket items. That slows down growth and makes the country's plans for change more difficult. Even though things are difficult in the short term, China's long-term goals are still clear. Leaders like Xi Jinping keep pushing the idea of making a country strong and able to handle its own technology. They've talked about dual circulation and new quality productive forces as ideas that will shape China's next economic age. The country wants to move up the global value chain, make itself less vulnerable, and take more charge of its economic future. It's still not clear if that will be enough to fight off the pressures of trade pushback from other countries, structural problems within the country, and aging populations. It is clear, though, that China's economy is not moving in the same predictable way it did in the past. It is taking big steps like buying gold, changing the way it trades with other countries, and trying to change the way people in the country buy things. But no one knows what will happen. The fact that the whole world is watching is certain. What China does now will not only affect its own future, but also the way the world economy grows in the years to come. How open and forward-looking the country's plans really are will determine whether it can adapt and do well or face even more trouble. The next few years are likely to be very important, not just for China, but for everyone.